All right, we are on chapter 4, completing the accounting cycle. Ever since chapter 1, I've been telling you chapters 1 through 4 is the ABCs of accounting. So if you can get these 4 chapters down, almost everything else from this point on will not be easy, but it will be doable. Okay, so we are going to do a video for 4.1 by itself and then one for 4.2 by itself. And then, oops, we will do 4.3, 4.4, and 4.5 together. And I've already showed you a worksheet, but I'm not going to actually do that whole objective there because we sort of left off on that. We will talk about it a little bit more in this chapter as well. So let's get started. First thing we're looking at is to prepare the financial statements, including a classified balance sheet. So before we get into classified balance sheet, let me write the balance sheet or the accounting equation down really quick. And you should know that at this point. If you don't, you probably need to study a little bit more. Okay. So remember, we had the balance sheet. It has got our assets, liabilities, owner's equity. A classified balance sheet, we're going to kind of categorize the assets and the liabilities. We won't actually do anything with owner's equity. It doesn't get classified. Okay. So the first thing underneath assets, we will have current assets. Okay. And then we will have long-term assets. Okay. Long-term assets. And some things that would be a current asset, obviously, cash, our accounts receivable. What makes it a current asset? Okay. It is a current asset if it is something we plan on using up within the next year. Okay. Long-term assets, those are things like your building, your land. They're not the things that you buy all the time, okay? A building, land, furniture, fixtures. We'll get into intangibles. So that would be copyrights, goodwill, and things like that. Okay, those would all be long term. Okay, we don't expect to use them up within the coming year. Okay, let me erase that just a little bit here so I got a little bit more room for my. Then we're going to come over here and we're going to do classify the liabilities. So we'll have current liabilities and long-term liabilities. Okay. Current liabilities, these are the things we plan on paying within the next period. Okay. That would be like our accounts payable, unearned revenue. Remember, that's a liability because of that little prefix there, UN. Um, Salaries payable, things like that that we are going to pay within the coming year. Okay, long-term liabilities, we would have notes payable. Now, we got to be careful. A notes payable could be current or it could be long-term. If it's something we're not paying for over a year, then it's going to be long-term. It could be a note payable up here as long as it's something we've got to pay within the coming year. Okay, so you got to be careful with that. All right, so why do we do this? Just to make accounting even harder, right? Well, we do this because we're looking at, do we have enough current assets to pay our current liabilities? We do this all the time, okay? We're looking at our checking account. How much money do we have coming in right now to pay the bills that are due right now? Are any of you worried about the bills you got to pay in 10 years? Probably not. Okay. Think about if you can't make your car payment today, but you can make your payment 5 years from now. It really doesn't matter, right? Because you're not going to have to make that car payment 5 years from now because they're going to come get the car and you won't have the car anymore. Okay. So it's very important, just like we pay our bills currently, it's very important for businesses to see, do we have enough current assets to pay our current liabilities? Okay. So we have our three financial statements. I'm so excited. They had them in order right here. So we have our income statement, we have our statement of owner's equity, and our balance sheet. Balance sheet's going to be classified, so it will be introducing that. I just like to draw that accounting equation out just so you can kind of see why we're doing that. Okay, so remember that last step. Okay, actually, I'm going to come down and I want to remind you of the accounting process real quick. We did journal entries in chapter 2, posted journal entries to the ledger, preparing an unadjusted trial balance. We just learned how to do adjusting entries, and I told you adjusting entries are harder than closing entries, so just hang on with me. All right, prepare an adjusted trial balance, then do the financial statements. Okay, so that's where they were at. And so remember, sometimes it matters where you're at in the process as to how to answer the question. Okay, so here we have that adjusted trial balance. It's really hard to see all those details in it, but we're going to jump down here and actually do the income statement first. But they did pull all those numbers from that adjusted trial balance. Okay, so I want you to notice the heading right here. Okay, headings are very important when it comes to financial statements because it's giving you a lot of information. We have the name of the company, we have the statement that we're looking at, and we have the time. And remember, the income statement is always dated for the month ended. For this one says 2 months ended December 31st. It could be for the year ended, for the quarter ended, for half the year ended. Okay. But if you leave that off and you just put December 31, 2025, it's wrong. Okay. It's wrong because that's not how it's stated. You are looking at all the revenues and all the expenses from, what is that, November 1st through December 31st. That is what they're telling you. That's what the users are saying about this statement. Okay. We start off with our revenues, and usually we might only have one or two types of revenues. That kind of makes sense, right? Most of the time we only have one job, but we got a whole lot of bills that we got to pay with that one job. So just like a business, we have several expenses, and take all those expenses away and we end up with net income of 8550. Remember, you have to do these in order. Okay, we're going to get to the owner's equity. This was a brand new business, so that's why this number is 0. In the next period, this is the ending. It will be the beginning in the next period. Okay. Notice the heading, name of the company, name of the statement, and then it's dated exactly like the income statement. Because again, it's looking at November 1st through December 31st. Okay. We are going to add the owner's contribution and we're going to add the net income. That net income came from right here. That is not on that trial balance. You have to calculate that number. Okay. And then the owner took some money out. So we end up with the capital balance of 51,550. Okay. So now we're going to look at a balance sheet. Okay. This is not the classified balance sheet yet. So we have our assets over here equal to our liabilities plus our owner's equity. Okay. We have to have that number right there comes from the previous statement. Lots of students will come back up here and they'll look at what was that capital account right there. They'll look at that and think that's the number, and then they don't balance. If you don't balance on your balance sheet, that's the first place to go look. Okay, that's probably where you made the error. It happens a lot. Even the best students miss that at least once. Okay, so we're pulling that 51,550. It's coming down here to the capital account. We have all of our assets right here, all of our liabilities, and just one owner's equity account on this statement. Notice it is dated December 31, 2025. Okay. Think of the first two statements that we just went over as we're watching a movie from the beginning to the end. On the balance sheet, think about you just took a snapshot. You just took one picture in time, and that is December 31st. Okay. So that, and if you wanted to remember it like this, because you have four financial statements, they're all dated just like this, except the balance sheet. The balance sheet is just one date and time. It is a snapshot. When we do statement of cash flows, it will be dated exactly the same as the income statement and statement of owner's equity. Okay. So now we're into this classified balance sheet. Okay. We're looking at a thing called liquidity. Liquidity means how fast can I turn this asset into cash? Okay. They kind of leave a little part of this definition off because I could turn, my car into cash really fast, especially if I said, okay, I have this 2011 Nissan Frontier. I'll sell it to you for $5. I turned it into cash fast, didn't I? Turning it into cash fast without losing fair market value. Okay. Without losing fair market value. If we wanted to empty a Walmart Supercenter of the inventory all in one day, we could do that. But we'd have to start off in the morning with 50% off, and by the end of the day, we would be giving it away. We lost a lot of the fair market value though. Okay. So liquidity means can we turn it into cash fast without losing a lot of our fair market value? Okay. All of those accounts up there in the current assets are all more liquid than the long-term assets. And think about that. We've got inventory and we have an accounts receivable. Those can be turned into cash a lot faster. Let's think about a building. Think about a Walmart Supercenter. If they decided to build another, and this has happened, Walmart will decide to build another building somewhere else and they leave an empty building. There's not a big market for an old Walmart Supercenter building. Okay. Usually the building sits there for a long time. That's not a very liquid asset because there's very few people interested in that type of asset. Okay. So that's liquidity. I've already talked to you about current assets being used or sold within 12 months. Okay. We have long-term assets. I don't think I mentioned long-term investments. I did mention intangibles and property, plant, and equipment though. Okay. And look, those are the exact accounts I used as our example for current liabilities. Those are the things that are coming due within the current year. Okay. And long-term liabilities, those are things we're not going to pay for later than 1 year. Okay. Owner's equity doesn't change. It looks exactly the same. Okay. It does not change when it comes to a classified balance sheet. Okay. So here they did a classified balance sheet for us. So now you can see we have a little bit of a breakdown. Our numbers are all the same, except for now we have this total for current assets. And we also have a number for, oops, sorry about that. Here we go. And we have a number for current liabilities right here. Okay. So they have current assets of 16,100 and they have current liabilities of 200, I'm sorry, 2,000. Okay. Um, we have this thing called the current ratio. It's in a different learning objective, but I'm going to come over here in the margins and we're going to talk about it one more time just because it's really important. It's a number that a lot of investors look at when it comes to analyzing financial statements. Okay. So remember, we have our current asset, long-term asset, current liabilities, long-term liabilities. The current ratio is just current assets divided by current liabilities. If you're an accounting major, you do have to have this formula memorized. I'm not making y'all memorize formulas for this class or even principles of accounting too. Okay. There's only a handful that even CPA exam candidates have to memorize, but this is one of them. And this one tells us a lot. Okay. So the current ratio for here is 16,100 divided by $2,000. And I did not do that math ahead of time. Let me do that really quick. So that is a current ratio of 8.05. Okay. So what does that tell me? For every $1 that I have in current liabilities, I have $8 in my current, over $8 in my current assets. You got a lot of current assets sitting around, and you got to remember, current assets don't make us near as much money as long-term assets do. So you have to find a perfect balance to have enough to pay the bills, plus have other invested so you can make more money from it. Okay. We'll talk a lot more about this when we get to financial management. So let me just throw out this crazy idea. What if that ratio was 50 to 1? So for every $1 in current liabilities, we have $50 in current assets. That's crazy. There's no textbook that will tell you that this number can get too large, but investors would not like to see this. It sounds great. You've got too much money being held up here in current assets, not making you any money. It would be the equivalent of me and you winning the lottery and putting every bit of that money in our checking account. If we did that, we're going to spend it, right? It would be better for us to go buy a building, go buy something, put it in something to invest long term because it's going to make us more money. We're not making a lot of money off of that extra that's in the current assets. So I would argue that it could be too high. Is there a golden rule on that? No, absolutely not. But even 8.05 is probably way higher than any industry average that we'll look at. Okay. All right. We will pick up with objective 4.2 in the next video.